So, we are starting our second webinar of the revision program for FRG paper, and today also we are discussing a mock paper, and this mock paper is in the same structure as your paper, but the number of questions is not as many as we get in your paper, because we have here time limitations for 2 hours, whereas you get 3 hours at the exam. But we have 3 sections, section A, section B and section 3, all the mandatory areas have been covered. So, we are moving on to discuss the questions straight. Section A, question number 1, MCQs. Which of the following would be classified as a liability? DPLC's business manufactures a product under license. In 12 months time the license expires and DPLC will have to pay 50,000 rupees for it to be renewed. CPLC purchased an investment 9 months ago for rupees 120,000. The market for these investments has now fallen and CPLC's investment is valued at 90,000 rupees. BPLC has estimated the tax charge on its profit for the year just ended as rupees 165,000. Expansion is planning to invest in new machinery and has been quoted a price of rupees 570. And before I give you the answer, and I must recommend you that before you do the video, you need to take the paper and do it on your own, do it alone and see how successful you will be, and then you can compare it with the answers which I give you. So, that is how you can assess yourself. If not, just watching it just for the sake of watching does not serve your purpose. Now, this is from the conceptual framework, and you need to retrieve your memories as to how liabilities were defined in the conceptual framework. How did we explain what a liability was? A liability is a present obligation to transfer economic resources arising as a result of a past event. So, those fundamental features need to be included there: present obligation from a past event and transferring economic resources. First one, DPLC's business manufactures a product under license. In 12 months time the license expires and DPLC will have to pay 50,000 rupees for it to be renewed. A past event has not occurred. Remember, as per LCS 37, for you to recognize sometimes a provision or a liability, this part is not discussed in the conceptual framework. The event that we talk about cannot be just an event, it has to be a past obligating event, very important. So, past obligating event has not occurred, and this is not a present obligation, it is going to be in 12 months time. So, now the fundamental 2 requirements are not satisfied. There are no the requirements of having to have a past obligating event, and that part is missing. Also, the requirement of having the requirement of existing a present obligation is not fulfilled. So, part A, the first answer A cannot be the correct answer as a result. CPLC purchased an investment 9 months ago for rupees 120. The market for this investment has now fallen and CPLC's investment is valued at 90,000 rupees. So, that talks about an investment. So, investment has got nothing to do with liabilities. This is an asset, not a liability. So, the B, answer B cannot be the accurate answer. Why? There is no liability there, instead there is kind of an asset. Third one, BPLC has estimated the tax charge on its profit for the year just ended rupees 165,000. That is something which is very closer to a liability. The past obligating event has taken place. What is it? If you carry out an economic activity the existing laws will become applicable and you get caught to pay taxes. So, you are carrying out a business activity where the profit you earn exceeds the required threshold. That should be the obligating event, and the assessment of 165,000 need to be paid immediately. You need to pay it immediately, and as you pay that, as you settle it, you need to settle that in cash. So, all the requirements are satisfied or fulfilled. What are the requirements? The requirement of there being a present obligation, that is there, and the present obligation arising as a result of a past event, even that is there, and transferring the requirement of transferring economic resources, even that is also there. So, 165 seems to be, let us look at the last one also. If not for the last one, C seems to be the most approximate and the closest answer for something to be a liability. Expansion is planning to invest in new machineries and has been quoted a price of 570,000. It is only just that the supply has given us the price and we have not even placed our purchase order, and no, as far as we can see, there is no liability in the fourth one. So, the accurate answer has to be C, that is the obligation to pay 165 worth of liabilities from the entity. So, we are moving to second one. Question number 1, Roman simple number 2. Which of the following would correctly describe the net realizable value of 2-year-old asset? And you know, once again, this has been given from the conceptual framework. When you prepare financial statements, assets, liabilities, income, expenses, forget about incomes and expenses, assets, liabilities, equity can be recognized at the values stipulated by the conceptual framework. You heard of historical cost, you have heard of the replacement cost, you would have heard of net realizable value, you would have heard of recoverable value, heard of entity specific value, heard of fair value less cost to sell, heard of present values of future cash. So, whatever the name given, they all eventually should conform to the values stipulated, specified in the conceptual framework. So, one such measurement given in the conceptual framework is net realizable value. You know how to calculate that. To calculate the net realizable value, you need to take the selling price within the normal business activities. Remember, that is important. You discussed that in LCS 2. Now, say for an example, if a customer turns up and buys the goods, buys your goods in an arm's length transactions within the normal business activities, so that has to be the selling price taken for NRV calculation. If a customer walks up to the showroom or to your business place and buys the goods, buys your inventories within the normal business activities, and that selling price should be the price to be taken for the NRV calculations. If you take bit of a different example where you have your obsoleted inventories or the inventories that are partly damaged and you have insured your inventories, and without you expecting a customer to buy them, you will transfer the inventories to an insurance company, take the insurance compensations. Now, what it says is, it's like you selling the inventories not to a customer within the normal business activities, that's like you selling the inventories to another party, insurance company, and the transaction occurs not within the normal business activities, outside the business activities, and that selling price cannot be taken for NRV calculation. NRV has to be estimated selling price minus estimated selling cost minus estimated cost of completion here, cost of completion does not matter, I mean that is not relevant here. So, you need to think of the estimated selling price within the normal business activities and estimated selling cost. So, which of the following would correctly describe the net realizable value of 2-year-old asset? The original cost of the asset less 2 years depreciation, so that is not accurate at all. Why? This is the carrying value. If an entity adopts the cost model, this is the carrying value, not the NRV. Second, the amount that could be obtained from selling the asset less any cost of disposal. And if not for the other answers, this answer seems to be the closest one, most approximate one, most appropriate one. So, let us see whether there will be some more suitable answers as we go ahead. C, the cost of an equivalent new asset less 2 years depreciation, that is not, that is something similar to replacement cost, so that is not the NRV. Then D, the present value of the future cash flows obtainable from continuing to use the asset, so that is something similar to value in use calculation. So, the most approximate, most relevant answer, the closest one to NRV seems to be the answer B. So, the answer should be B. Third one, APLC has built a new factory incurring the following cost. The figures are in 1000, land 1002, materials 2004, labor 3000, architects fee 25, surveyors fee 15, site overheads 300, apportioned administrative overheads 150, testing of fire alarms 10 and business rates for the first year, altogether 7112. What will be the total amount capitalized in respect of the factory? Right. So, remember, you need to understand the questions and the expectations of the examiner. So, it is very bit of a tricky one. Unless you read the mind of the examiner, you can't do it, but to some extent you should be able to read the minds of the examiner to realize what the examiner expects you to write. Now, it is the amount that can be capitalized to the building, to the factory, not to the building. Factory, and you all need to go on adding the directly attributable cost until this asset is prepared to the intended level. So, what is the intended level of this asset? Since it is a factory, eventually the intended level of the asset should be that you need to develop the building, develop the constructions in a way that it can be used for manufacturing purpose. So, until you make this building suitable for manufacturing purpose, you need to go on adding, you need to keep adding directly attributable cost. You know what directly attributable cost is? It is a very simple concept now. To understand the directly attributable cost, you can question yourself, if a particular, or is it a cost which can be avoided if not for the building, if not for the factory? Yes, it is a directly attributable cost. Is it a question, is it a cost which can be avoided if not for the construction? No, it is not a directly attributable cost. Very simple example, without constructing the building, just imagine we deciding to buy the building, it is already constructed, and if you pay say 1000, I am just taking simple figures, 1000 to the seller, if not for the purchase of the building, you would not pay 1000 to the seller. So, it is directly attributable. And here in the company, in the business, we have a separate purchase department that handles all the purchases from the beginning right to the end. And we pay 500 worth of salaries, remunerations to the staff in the purchase department. And what if you decide to add this 500 salary payment to the purchase department also to the cost of the building? That does not fall in line with the requirements of the standard. Why? 1000 payment to the supplier is a payment which can be avoided if not for the purchase of the asset. 500 payment of salaries to the people who work in the purchase department is kind of an expenditure which you cannot avoid from even if you decide not to purchase the asset. So, this cost cannot be avoided even if not for the purchase of the asset, cannot be avoided. So, if it is a cost which cannot be avoided if not for the purchase of the asset, it is not a directly attributable cost. The previous one of 1000 payment to the seller of the building is kind of a cost which you can avoid if you decide not to purchase, and that is a directly attributable cost. So, that is what is required to understand in order to answer this question. Land 1200, it is directly attributable. Why? Now, the land is assumed to have been fully consumed for the constructions. If the land is 1 acre, right across the whole land the building must be standing. On every single speck of dust of the land, the building is standing. So, 1200 land cost would have been able to be avoided from unless you decided to construct the building, it has to be taken. Materials 2400 directly attributable. Why? If you decided not to construct the building, you would not consume the materials of 2004. So, it is a kind of a cost which you can avoid from unless you construct the building. Labor cost 3000. Labor cost of 3000 should be directly attributable. Why? Even the labor cost can be avoided from if you decide not to construct the asset. Architect's fees how much? 325 rather, is a directly attributable cost. Why? If you decide not to construct the building, you would not get someone to draw the architectural plan. Surveyor fees once again is a directly attributable cost. Why? If not for the construction, you would not get it surveyed. Site overheads how much? 300. This is once again a directly attributable cost. Why? If not for the construction of the building, you would not incur site overheads. Apportioned administrative overheads, that is where you need to think of it a bit in depth, and administrative overheads, even if you decide not to construct the building, the overheads incurred within the office of your business, administrative office, not in the site. There is no administrative expenses in the site. This is the administrative expenses incurred within the office of your entity, that continues to incur despite of the fact that whether we decide to construct the building or not. So, that 150 cannot be taken. Testing fire alarms, that is bit of a contentious area. Why? Once again, it is directly attributable, fine. If not for the factory constructions, we would never buy fire alarms testing. But is it necessary to prepare the asset to the required intended level? Now, if the examiner asks you to calculate the cost of the building, that would not have been required, just the building. But testing fire alarms may be mandatory. Sometimes you need to get the regulatory approval to function the factory. So, the regulatory approval will be granted only after inspecting from A to Z. They need to satisfy themselves everything is in place. So, among those requirements is fire alarm, so you need to test them. So, for you to prepare this building to a factory, fire alarms, that kind of an expenditure is a must. It is inevitably incurred. So, it is a mandatory requirement. So, remember, depending on the expectations and the requirement of the examiner, that can be different. So, 100 need to be added fire alarms testing. So, those are the expenses to be taken. Let us see what the final figure should be. 1200 plus 2004 plus 3000 plus 25 plus 15 plus 310. So, it is 6950. 6950. So, the answer has to be B, 6950, and let us move on to the fourth one. Right. APLC had the following bank loans outstanding during the whole of 2018. 9% loan payable, 2019 15 million. $15 million, 9%. 11% loan repayable, 2022 24 million. 24 million into 11%. APLC began constructions of a qualifying asset on 1st April 18 and withdrew funds of rupees 6 million on that date to fund construction. On 1st August 2018, an additional 2 million was withdrawn for the same purpose. Calculate the borrowing cost which can be capitalized in respect of this project for the year ended 31st December 18. Now, sometimes 23, LKS 23 seems to be a simple standards where we expect the questions to be given from LKS 23 can be so simple. But the danger is sometimes the questions from LKS 23 can be coupled with questions from financial instruments, like the examiner can say an entity has issued a bond, a redeemable bond, specifically for the purpose of, exclusively for the purpose of financing the construction of a building, and lot of financing components are given, and you need to work out the amount of borrowing cost to be capitalized. Before you decide the amount of borrowing cost to be capitalized, maybe lot of calculations need to be first done before you arrive at the final amount of finance cost to be capitalized. Sometimes the examiner can be little harsh and rude. So, now this is not that hard. Now, one thing you need to understand, the entity has raised altogether 39 million. 39 million. And out of 39 million, at 2 occasions they have utilized only 8 million for the construction during the year. If those financing are exclusively to construct the building, for you to exhaust the entire 39 million, you need to wait until the building or the construction is over. Now, you will utilize the funds from the borrowings only up to the extent of the building has been completed. Here, out of 39 million, we utilized only 8 million. Now, the examiner does not say where or which borrowing this 8 million has been taken from. If the examiner specifically said that 8 was taken from the first one, simply you take 9% for borrowing cost calculation. If the examiner said the rate was taken from 24 million, it is just a matter of applying 11% to calculate the amount of borrowing cost to be capitalized. Now, to some extent, for the purpose of making this question little hard and complicated, the examiner absolutely keeps silent, remains silent on that part. So, we do not know where and from which borrowing 8 million has been utilized from. So, now you have to make an assumption that this 39 million is kind of what? Is kind of a pool of funds to which different source of finances have been used and then first and foremost you need to calculate a common rate. Here we call it the capitalization rate, or even we can call it what? Weighted average rate. So, different methods are available. You can use any method as you have studied before, and let me use a simple method. Now, 11% will be multiplied by here 15 divided by 39, or else we can have another simple method. What we can do is we will calculate the interest for each borrowing. 15,000 into 9%, it is 1,350. 24,000 into 11%, this is 2,640. Now, these two will be considered to be a single loan, single financing facility, where the total interest on that is considered to be this is 3,990. Then 3,990 has been the total finance component for a total borrowing of 39,000 into 100%. 3,990 divided by 39,000 into 100, so you will get 10.23. 10.23. So, this is the common rate. Very simple. Take the interest rate for this, also take the interest for this, and these two will be assumed to have been a single borrowing. Then this total interest payment 3,990 is considered to be the total interest payment for this common borrowing. If the interest is so much, for so much of a loan, what should be the common rate? 10.23. So, this is what has to apply for the amount utilized for the construction during the year, irrespective of whether it was drawn from the first loan or from the other. So, what does it say? How much does it say we have used during the year? Out of 8 million, 6 million has been drawn on which date? 1st April, and they want us to do the calculations for the year ending 31 December 18. So, this into 10.23 divided by 12 into 9. So, 6,000 into 10.23 divided by 12 into 9, into 9 is 460.35. The balance 2 was drawn on 1st August 2000 into 10.23 August. How many months? August, September, October, November, December. 5 months divided by 12 into 5. 2000 into 10.23 divided by 12 into 5. So, that is 85.25. 85.25 plus 460.35. So, it is 545.6. Let us see. So, the closest answer is A. So, the answer has to be A, 560,000, closest one. Then we will go to fifth one. A machine has a carrying amount of 85,000 at the year end of 31st March 19. Its market value is 78,000 and cost of disposal are estimated at 2,500. A new machine would cost 150,000. A new machine would cost 150,000. The company which owns the machine expects to produce net cash flows of 30,000 rupees per annum for the next 3 years. The company has a cost of capital of 8%. So, what is the impairment loss on the machine to be recognized in the financial statements? So, you need to go apply the requirements of LKS 36 impairment. Let us take the carrying value, take the recoverable value. Recoverable value should be the higher of value in use and fair value less cost to sell. So, what does it say the carrying value is? Carrying value is 85,000. At the year end of 31st March 19, its market value is 78,000 and cost of disposal are estimated at 2,005. So, 78,000 minus 2,005, fair value less cost to sell should be 75,500. Value in use, it is not straight away given, but you need to perform just a simple calculation to find it out. 30,000 per annum for the next 3 years, cost of capital is 8%. So, you need to find out the value in use calculations. You can simply take the annuity factor at 8% for 3 years and then you can find out the value in use. 1 minus 1.08 to the power minus 3 divided by 0.08 and that into 30,000 gives you value in use, or else you can take 3 years at a stretch and you can go on discounting, and this method is very easy. 1.08 to the power minus 3 so that becomes to 77,312 value in use. So, the recoverable value should be the higher value is 77,312. So, carrying value of the assets cannot be recovered from the future cash flows, cannot be recovered. So, let us work out on impairment loss. 85,000 minus 77,312, it is 7,688. So, the answer has to be A, part 5. Sixth one, APLC acquired a 60% holding in the 100,000 1 rupee shares of MPLC on 1st January 18, when the retained earnings of MPLC were 850,000. Retained earnings 850. Consideration comprised 250,000 cash. So, let me open up. Let us see what the requirement is. What is the goodwill arising on acquisition? So, based on that, let us see what to be taken, what not to be. And let me open up the cost of control account for the goodwill calculations. You can open up depending on what you have learnt in the classes. It can be just T accounts or statements, but if you do statements, the chances of you making mistakes will be so high, and you can't keep a track of where you have made mistakes and where it has gone wrong. So, T accounts you can quickly spot and track where the mistake has been. Now, retained earnings on the acquisition date 850,000, 850. Then consideration comprised of 250,000 cash, cash consideration 250,000, fine. 400,000 payable on 1st January 19, 400. So, then cost of capital is given, that is in 1 year's time. So, deferred consideration 400,000 divided by 1.08, 1.08. So, 400,000 divided by 1.08, it is 370, 370 deferred consideration. And 1 share in APLC for each 2 shares acquired. Parent company acquired 60,000 shares. How does it come? Total number of shares in company M is 100, out of which A acquired 60%, which is 60,000. So, parent company has issued 1 share for every 2 shares in company M, and this is the non-cash consideration which is measured at the fair value. So, what is the market price? What are the questions say? The market price of a share of the parent company has been on the acquisition date. Market value of its shares on 1st January 18 was 2.3. This is to be multiplied by 2.3. 30,000 into 2.3. So, that is 69,000. 69,000. Then share capital should be 100,000 and non-controlling interest, non-controlling shareholders, it says APLC measures non-controlling interest at fair value. The fair value of the non-controlling interest at 1st January 18 was estimated to be 400,000. Non-controlling interest is measured at 400,000. Let us bring it here and we will close it up and find out the goodwill. 250,000 plus 370, 370 plus 69,000 plus 400,000. It is 1,89,370. 1,89,370 minus 950,000. It is 139,370. 139,370. Let us see whether it is there in the answers. Yes, answer has to be A, 139,370. Seventh one, on 1st June 2011, PPLC acquired 80% of equity share capital of SPLC at the date of acquisition. The fair value of SPLC's net assets were equal to their carrying amounts with the exception of its property. This had a fair value of 1,200,000 below its carrying amount. So, if you fair value them on the acquisition date, so there is a fair value loss which has to be charged to profit and loss on the acquisition date. The property had a remaining useful life of 8 years. This is divided by 8 to calculate depreciation overcharge now. So, what effect will any adjustment required in respect to the property have on group retained earnings at 30th September 2011? Acquisition date is 1st June 2011. Reporting date is 30th September 2011. How many months? June, July, August, September, altogether 4 months, right. Now, this is not kind of a adjustment in consolidations which we used to have in the class calculations, the questions. Why? Always we used to have in most of the cases a fair value reserve, fair value gain, and then we used to recognize excess depreciation. You need to depreciate more. Here it is the other way around. There was a fair value loss on the acquisition date. So, the profits which subsidiary company calculated based on their book value seems to be pretty higher than what is required within the group. So, you need not to recognize additional depreciation, instead you need to reduce the depreciation which they have already recognized in their individual books. Subsidiary company has over depreciated assets by now by how much? 1.2 million divided by 8, that is for a year. This is divided by 12 into 4, and you need to reverse 50,000 worth of depreciation, and if you reverse depreciation, the profit figures will move up. The profits figures will increase if you decide to reverse depreciation. Now, 50,000 is the adjustment for the parent and to NCI both. So, the parent portion should be only 80%. So, now as a result, parents profit figure should increase by 40,000 when you complete the adjustment. Parents profit figure should increase by 40,000 if you do the adjustment. So, the answer has to be C, increased by 40,000, increased by 40,000. 8th one, on 1st August 17, PPLC purchased 18 million out of 24 million of 1 rupee equity shares of SPLC. And let us work out on the percentage. 18 out of 24. What is the percentage? 75%. 75%. The acquisition was through a share exchange of 2 shares in PPLC for every 3 shares in SPLC. For every 3 shares in SPLC, parent has given 2 shares. The market price of a share in PPLC at 1st August 17 was 5.75. PPLC will also pay in cash on 31st July 19, 2 years after acquisition, 2.42 per acquired shares of SPLC. PPLC's cost of capital is 10% per annum. What is the amount of the consideration attributable to PPLC for the acquisition of SPLC? It is not the goodwill, it is not the retained earnings after the acquisition. Simply you need to calculate the fair value of the investment made by the parent by including all the ingredients into it. Now, take the first one. fair value of non-cash consideration. Fair value of non-cash consideration. Parent acquired 18 million and parent has issued 2 shares for every 3 shares in SPS. This is divided by 3 into 2 and this is multiplied by the fair value of a share on the acquisition date. It says the market price of a share in PPLC at 1st August 17 was 5.75. This is multiplied by 5.75. 18,000 divided by 3 into 2 into 5.75. 69 million. 69 million. PPLC will also pay in cash on 31st July 19, 2 years after acquisition, 2.42 per acquired shares. Then say deferred consideration. Deferred consideration. 18,000 into 2.42 discounted by 10% over 2 years. 18,000 into 2.42 divided by 1.1 to the power 2 should be 36,000. Should be 36. Take the total now. 0, this is 5, 105. Total consideration should be 105. So, the answer has to be A, question number 8 or question number 1 part 8. Ninth one, which of the following situations does not suggest a leasing arrangement constitutes a finance lease? The present value of the minimum lease payments is substantially less than the fair value of the asset. Which of the following situations does not suggest that a leasing arrangement constitutes a financing lease? The present value of the minimum lease payments is substantially less than the fair value of the cost. Ownership in the asset is transferred at the end of the lease term. Where the ownership passes to the lessee end of the lease term, that is supposed to be a finance lease. The lease term is for a major part of the asset's useful lifetime. Where the lease term is for a major part of the asset's lifetime, that again is considered to be a finance lease. The lease contains a purchase options at a price below fair value which is reasonably certain to be exercised. Where the lessor has given an option the lessee to buy the asset at a price which is significantly lower than the fair value on the date of the purchase, and the lessee is very much likely of exercising the option, even the lease is considered to be a finance lease. So, the first one is the correct answer. The present value of the minimum lease payment is substantially less than the fair value. In a finance lease, the present value of the minimum lease payments is considered to be almost similar and equal to the fair value. Here it is going to be the other way. Present value of the minimum lease payments will be substantially lower than the fair value, and then only that does not become a finance lease. So, the answer has to be A. 10th one, CPLC is being sued by a customer for 2 million for breach of contract over a cancelled order. CPLC has obtained a legal opinion that there is a 20% chance that CPLC will lose the case. It is only just 20% chance. So, it is not probable. Accordingly, CPLC has provided 400,000, 2 million into 20% in respect of the claim. The unrecoverable legal cost of defending the action are estimated at 100,000. They have been provided, these have been provided as the case will not go to court until next year. These have been provided as these costs have been provided as the case will not go to court until next year. What is the amount of the provision that should be made by CPLC in accordance with LCS 37, provisions, contingent liabilities and contingent assets? You cannot provide 2 million at all. Why? It is not probable, and there is only just a 20% chance of CPLC has obtained legal opinion that there is only 20% chance that CPLC will lose the case. So, there is only just a 20% chance of losing the case, it is not probable. And it does not say that you should provide at the level of probability. What does it say? You estimate of being ordered by courts to pay 2 million rupees altogether, and the chance of losing the case is 20%. It does not say that you should pay 400,000 as compensation, 400,000 as compensation, no. But then you need not to provide at all for the pending legal case. Why? It is not probable. Then you have entered into the contract with the lawyers who will defend you in courts, and the lawyers are asking 100,000 rupees. So, whether you lose it or whether you win it, you are under the obligation to pay 100,000 to the lawyers, and that is something that you can't avoid from. So, an obligating event has taken place to pay 100,000 to the lawyers, and there is no option to avoid it, and you must pay it, and there is a present obligation, and there is a probability of transferring there is probability of transferring resources with economic benefits. So, 100,000 should be provided for. So, the answer has to be D. So, then we move on to section B. Section B, question number 2. PPLC is in the process of preparing its financial statements for the year ended 31st October 16. The company's main activity is in the travel industry, mainly selling package holidays, flights and accommodation to the general public through the internet and retail travel agencies. During the current year, the number of holidays sold by travel agencies declined dramatically, and the directors decided at a board meeting on 15th October 16 to cease marketing holidays through its chain of travel agents and sell off the related high street premises. Immediately after the meeting, the travel agency staff and suppliers were notified of the situations, and an announcement was made in the press. The directors wished to show the travel agency's results as a discontinued operations in the financial statements of 31st October 16. Due to the declining business of the travel agents on 1st August 16, 3 months before the year end, PPLC expanded its internet operations to offer car hire facilities to purchasers of its internet holidays. The following are PPLC's summarized profit or loss results year ended 31st October 16 and 31st October 15. So, the details are provided. The results for the travel agencies for the year ended 31st October 15 were revenue 18 million, cost of sales 15 million and operating expenses 1.5 million required. Discuss whether the directors wish to show the travel agency's results as discontinued operations is justifiable, Assuming the closure of the travel agencies is a discontinued operation, prepare the summarized statements of profit or loss of PPLC for the year ended 31st October 16 together with its comparatives. Right. So, there are two elements in the question. The first one is a requirement of discussion whether this will result in a business operation from being discontinued rather. Internet and retail travel agencies during the current year, the number of holidays sold by travel agencies declined dramatically. And the directors decided at a board meeting on 15th October 16 to cease marketing holidays through its chain of travel agents and sell off the related high street premises. Immediately after the meeting, the travel agency staff and suppliers were notified of the situations and an announcement was made in the press. The directors wished to show the travel agency's results as a discontinued operations in the financial statements. Right. Now, this is all right, that is a discontinued operation. To see whether it is a discontinued operations, you need to look at the requirements of SLFRS 5. And SLFRS 5 gives you the required criteria to see whether it is a discontinued operations. And the second part of the question is asking us to prepare the summarized summarized statement of profit or loss of PPLC for the year ended 31st October 16 together with its comparatives. So, the first part I am not going to discuss in detail, but it is very simple, straightforward. It is a collection of assets which contributes to a single cash flow, and here they decided to cease operations. So, that will result in a business operation from being discontinued. So, no issue. And then how are we going to present that in the financial statement? So, they want us to prepare a summarized statement of profit or loss of PPLC. Right. Then let me show you how the profit and loss will be prepared with the required disclosures. You need to show the continuing operation first, continuing operations. Continuing operations. This is the current year 2016. Also, you need to provide the comparatives. Comparatives should be for 2015, and in the real sense of the word, comparatives need to be comparable. If not, there is the purpose of providing comparative information will not be served, will not be achieved. Now, what is the business that is going to be discontinued? Travel agencies, and that has altogether a profit figure of how much? It is a 4,000 profit figure. It is a 4,000 profit figure, or it is going to be a loss. If revenue is 14,000, cost of sales is 16,005, so the gross loss is 2,005 and operating expenses 1,005, and there is a loss of how much? 4,000, loss of 4,000, and it has to be within brackets. I must tell you that you need to put that within brackets, if not it is misleading looking. And the car hire 400, final profit figure of the business should be 400. Now, we will show here only the continued operations of internet business and car hire. So, let me take the figures. Revenue 23,000 plus 2,000 is only 25,000. So, let me complete the comparatives after completing this one. Cost of sales, internet 18,000, car hire 1,005, so that should be 19,005, 19,005 gross profit. gross profit. Gross profit should be, this is 4005, rather 5005. Then operating expenses, internet 1000, car hire 100 has to be 1100. Then profit for the period, profit from continuing operations. Profit from continuing operations 4400. Then only you bring the results of discontinuing operations, the operations that are going to be discontinued hereafter. Say profit or loss from discontinuing operations. Discontinuing operations, what is the loss? Loss is 4000. So the final result is 400 profit. And you know, your presentation of comparative information should be consistent with that of the presentations in the current year. Now we are given the figures for the last year. Revenue is 40,000, but that is not what we are going to disclose now. It says travel agencies for the year, last year they had a revenue of 18 million. Then we will take only the revenue for the last year, revenue of the last year only for the operations which are to be continued. So 40 minus 18, how much? It has to be 22,000. Revenue should be 22,000. Cost of sales, total cost of sales last year 32 minus the cost of sales of the operations to be discontinued 15. So 32 minus 15 should be 17. Then the gross profit is 5,000. Gross profit should be 5. Operating expenses 1.5. It has to be 500, made a mistake. Total is 2000, and the expenses of the operations to be discontinued for the last year is 1005, so should be 500. Then this is profit from continuing operation should be 4005 for the last year. And last year, let's take the profit or loss from the operations to be discontinued. So it says revenue 18 million, cost of sales 15 million minus operating profit 1.5, so that has to be 1500. Profit from continuing operations for the last year, it was a profit last year, so this has to be 6,000 profit for the last year, 6,000 profit for the last year, right. And also you need to provide a note on discontinued operations, note on discontinued operations. 2016, 2015, current and the comparatives, revenue, cost of sales, gross profit, operating expenses, then the profit. Revenue 14,000 current year, cost of sales 16,005, so there is a gross loss of 2,005, operating expenses 1,005, and there is a loss from discontinued operations, profit or loss from discontinued operations 4,000. For the last year, revenue has been 18,000, cost of sales has been 15,000, gross profit was 3, and operating expenses 1,005. So, the profit for the last year has been 1,005. So, that is what is required for the second part of the question, and let us move on quickly to part B. Describe the circumstances in which an entity changes its accounting policies and how a change should be applied. And that is a very straightforward question, there is nothing to think of. Since your exam is an open book exam, even you can pick the answer straight from the standard book, and you need to keep your answer book tagged, separating each standard from the others, and you need to find out quickly where the standard LKS 8 says the circumstances where the accounting policy changes are permitted. Accounting policies can be changed only at two instances, two circumstances. If the change of the accounting policy is required by another accounting standard, no problem, you need to go ahead and to change the accounting policy. Then if the entity can justify and substantiate that the change of the accounting policy will only result in the financial statements to be presented the events and the transactions more faithfully and relevantly, then you can again change your accounting policies. Now, except for those two instances, an entity cannot change the accounting policies anywhere else, and if you decide to adopt an accounting policy, it has to be consistently used and applied in the current year as in the previous year. So, that is the answer for part B, Roman simple number 1. Part B, Roman simple number 2, the terms under which P PLC sells its holidays are that 10% deposit is required on booking and the balance of the holiday must be paid 6 weeks before the travel date. 10% deposit should be paid is required on booking. At the point of the booking, you receive 10% deposit and the balance of the holiday must be paid 6 weeks before the travel date, 6 weeks before, that is the policy. In previous years, PPLC has recognized revenue and profit from the sale of its holidays at the date of the holidays is actually taken. From the beginning of November 2015, PPLC has made it a condition of booking that all customers must have holidays cancellation insurance, and as a result, it is unlikely that the outstanding balance of any holidays will be unpaid due to cancellation. In preparing its financial statements to 31st October 16, the directors are proposing to change to recognize revenue and related estimated cost at the date when a booking is made. The directors also feel that this will help to negate the adverse effect of comparisons with last year's results, year ended 31st October 15, which were better than the current years. Required comment on whether PPLC's proposal to change the timing of its recognition of its revenue is acceptable and whether this would be a change of accounting policy. Now, it is bit of a lengthy discussion or bit of a lengthy story given. I do not think you can remember everything here. What it says in a nutshell, that we are a service provider and we are receiving 10% advance in advance, we are receiving a 10% deposit in advance, and the balance 90% should be paid to us 6 weeks before the travel date. So, we are receiving everything well in advance. Now, sometimes we have a chance of losing some part of our revenue why the customers will cancel their holidays. So, we have a problem of not being able to receive the entire amount of 100% because subsequently some customers will cancel their holidays. Now, here what has happened is later on, for all the customers who do the bookings with us require us to give us an insurance. What does it say? It has to be an insurance holiday cancellation insurance. So, what happens is even when the customer cancels it, we are not losing anything because the insurance company will pay us. So, there is a guarantee, an endorsement, or there is a guarantee of our revenue being received in full, and we have very insignificant probability and a chance of losing some part of revenue now. Why? And the insurance company will compensate us for the loss of our revenue. So, then the entity will think of changing their accounting policy of recognizing revenue well in advance. Now, what was the method before? They used to recognize their revenue at the time of providing the service to the customer. Why? Then only they have the probability of receiving all the considerations of their revenue for the services to be provided. Now, what has happened is, since the insurance company will compensate us even when the customer does not pay, we have the assurance of being able to recover everything. So, they decide to advance the point of recognizing revenue hereafter in consequent of the insurance company giving us the assurance. So, whether it is an accounting policy or whether you can change your revenue recognition point just because you get a third party assurance of you being paid any amount that the customer does not pay you. Here, anyway, if you stick to SLFRS 15, you need to recognize revenue when the performance obligations are satisfied. What do you mean by the performance obligations here? You need to question yourself to identify the performance obligations. In short, question yourself, what are we receiving this consideration for? To provide the service to the customer, to provide the holiday service to the customer, say to provide the service to the customer. Then, even when the customer gives you an assurance, or even when an outside party gives you the assurance of you being compensated for any possible losses out of the receivable from the customers, the way of the pattern of you satisfying the performance obligation changes or does not change? Does not change. Irrespective of whether you are receiving the total amount from the customer himself or whether you are receiving part of the consideration from the customer and the balance part from the third party, how you complete the performance obligations will not change. The performance obligations will remain the same of being satisfied later when the customer consumes the service from you. So, as a result, this is only just that a change of receiving the considerations, a change of the point of receiving the consideration, not a change in the way of providing the services. It is not a change in the pattern of satisfying the performance obligations. So, you cannot change the point of recognizing revenue. Still you need to recognize the revenue at the time of satisfying the performance obligations. This is not going to be an accounting policy, and you can't change it either. You can't change it either. So, it is not going to be any change in accounting policies, and you cannot change the point of recognizing revenue also. Then quickly we will move on to question number 3. For the year ended 30th September 18 was 15 million. So, let me jot down the critical facts here. Profit after tax 15 million. At 1st October 17, the company had in issue 36 million equity shares. Number of shares in issue 36 million. And 10 million 8% convertible loan notes. Loan notes 10 million at 8%. The loan note will mature in 2022 and will be redeemed at par or converted into equity shares on the basis of 25 shares for each 100 of loan note at the loan note holder's option. On 1st January 17, BPLC made a fully subscribed right issue. That was on 1st January 17. 1st January 17, a right issue. A right issue of 1 new share for every 4 shares held at 1 for 4 at 2.8. The market price of the equity shares of BPLC immediately before the issue was 3.8. Market price before the right issue was 3.8. The earnings per share reported for the year ended 30th September 17 was 35 cents. Last year 35 cents earnings per share. Calculate the basic EPS figure for BPLC and the diluted EPS that would be disclosed for the year ended 30th September 17. Now, we have to calculate the basic for the current year. Also, you need to restate the comparative basic EPS. So, let us complete first the basic EPS. To calculate the basic EPS, what do we need? You need profits attributable to ordinary shareholders divided by weighted average number of ordinary shares. Now, you all know where there is a right issue, a right issue is considered to include from a bonus element as well as a cash element. The way you treat the bonus element is different to the way you treat the cash element. So, until such time you separate out the bonus element and the cash element from each other, so we can't proceed with the EPS calculation. So, first and foremost, the prime duty for you to split out this right issue into the cash element and into the bonus element. So, that has to be the first part to be done. If not, we can't complete these calculations at all. Now, to complete the bonus element calculations and the cash element calculations, I can't explain logically how the bonus element is included there. It takes a longer time, and you would have learned that from your normal theory classes. You need to calculate, you need to perform two calculations. One is theoretical X-right price calculation, TERP calculation. market value of the shares, before the right issue, plus proceeds from the right issue. So, different formulas are available and there is nothing wrong, you can use whatever you think is comfortable with. Then the number of shares before the right issue plus number of shares in the right issue. So, let us take the figures. Market value of the shares before the right issue. Before the right issue, we had 36 million shares. So, what does the question say? The market price of a share was 3.8 plus proceeds from the right issue. How many shares have you issued under the right issue? 1 for 4 existing shares. To calculate the number of shares in the right issue, you can divide 36 by 4 and multiply it by 1, should be 9,000. And what is the price at which the right issue was done? 2.8. So, this is divided by the number of shares before the right issue, 36,000, plus the number of shares in the right issue, 9,000. So, if you simplify this, 36,000 into 3.8 plus 9,000 into 2.8. So, this is 162 divided by 36 plus 9 should be 45. So, 162 divided by 45 should be 3.6, that is the theoretical ex-right price, meaning the expected market price of a share after the right issue, Then the adjustment factor. To calculate the adjustment factor, what do? Market price per share is divided by theoretical ex-right price per share. So, what does the question say? The market price of a share was 3.8 divided by theoretical ex-right price 3.6. So, what is the answer? 3.8 divided by 3.6, 1.055. 1.055. So, 1 has to be the number of shares before the right issue and your digits on your right hand side 0.055 should be the bonus element. So, let me split it out now. Bonus element in the right issue. So, what did I say? 1 is considered to be equal to the number of shares before the right issue, 36 into 0.055 should be the bonus element. 36,000 into 0.55 is 1,980, that is the bonus element. Then take the cash element. Cash element is 9,000 shares in the right issue minus 1,980 bonus element. Cash element should be 7,020. So, let us proceed with the basic EPS calculation for the current year first and then the restated EPS for the comparative period. Profit after tax 15,000 divided by the number of shares at the beginning 36. The bonus element is considered to have occurred during the earliest period reported and it should be taken for the full year. And the cash element of 7,020 and you should take it for how many months the bonus issue has taken place on First January 17 and the year end is on 30th September. So how many months? 9 months. This is divided by 12 into 9. Take the figure 7020 divided by 12 into 9 plus 1980 plus 36,000. So, number of shares is that 15,000 divided by the number of shares weighted average. So, the basic EPS for the current year should be 34 cents 34 cents. Also, you need to work out on restated EPS, restated. It's a simple one, need to work out the last year profit. Last year profit is equal to what? Last year EPS, last year basic EPS was 35 cents. 35 cents multiplied by 36,000, you get the profit then. It's divided by 36,000 plus bonus element of 1,980. 36 into 0.35 divided by 36,000 plus 1980. So that is 0.33. Restated EPS for the last year should be 0.33. Then we will complete diluted EPS. Diluted EPS $15,000 profit divided by 36,000 plus 1,980 plus 7,020 divided by 12 into 9 plus what are the potential instruments given? There is a convertible instruments of 10 million rather. 10,000 into 8%, interest need to be added back, and what does it say the tax rate has been? Tax rate is 25, so this is multiplied by 75%. And also take the number of shares into which the convertible loan stock, loan notes are convertible into. It says 25 shares for each 100 rupees loan. So this is 10,000 divided by 100 into 25. Right. So let's work it out. 10,000 into 0.08 into 75%, 600. 15,600 divided by the number of shares. 10,000 divided by 100 into 25 is 2,005 plus 7020 divided by 12 into 9 plus 1,980 plus 36,000. Number of shares 45, 745, 15,006 divided by this. So the diluted EPS has to be 0.34. 0.34, 34 cents should be the diluted EPS. Then question number 4, the issued share capital of SPLC as at 31st March 15 was 21 million. Its shares are denominated at 25 cents each. On 1st April 15, PLC issued 20 million rupees 8% convertible loan stock at par. The terms of conversion on 1st April 18 are that for every 100 rupees of loan stock, 50 ordinary shares will be issued at the option of stockholder. Alternatively, the loan stock will be redeemed at par for cash. Also on 1st April 15, the directors of SPLC were awarded share options of 12 million ordinary shares exercisable from 1st April 18 at 1.5 rupees per share. The average market value of SPLC's ordinary shares for the year ended 31st March 16 was 2.5 rupees each. The income tax rate is 25%. Earnings attributable to ordinary shareholders for the year ended 31st March 16 were 25,200,000 rupees. The share options have been correctly recorded in the financial statement. Required to calculate SPLC's basic and diluted earnings per share for the year ended 31st March 2016. So, let us complete the basic EPS. Profit attributable to ordinary shareholders divided by weighted average number of ordinary shares. Profit attributable to ordinary shareholders, it says the profit for the year 25,200,000, 25.2 million, weighted average number of shares the value of the share capital is 21 million and this is divided by 0.25 to calculate the number of shares. 21 million divided by 0.25, 84,000. Then 25,200 divided by 84,000. So, the basic earning per share should be 0.3, 30 cents. Diluted earnings per share, right. So, there are two potential instruments, share options and a convertible instrument as well. So, they want us to do the full dilutions, we will take both of them together as a result. Now, let me calculate dilutive effect of the share options. How many shares under the share option? 12 million minus 12,000 into the price at which shares are supposed to be issued, 1.5 divided by 2.5. So, this is 12,000 into 1.5 divided by 2.5, 12,000 minus this 4,800 dilutive effect. Then loan stock can be straight away taken. So, let us go to diluted EPS calculations. Diluted EPS calculation. Profits 25,002 divided by 84,000 shares in issue. The options are considered to be the most dilutive item amongst everything. So, 4,800 dilutive effect is taken, no impact on profitability. And we have a convertible debt instrument of, it says 20 million, 20,000 into 8% into tax rate is given 25%. So, this is multiplied by 75. The number of potential shares into which the loan stocks are attributable into, it is 20 million. What is the conversion rate? For every 100 rupees of loan stock, 50 ordinary shares. So 20,000 divided by 100 into 50 shares. 20,000 into 8% into 75% plus 25,002, 26,400 divided by 20,000 divided by 100 into 50 plus 4,008 plus 84,000, 98,800. 26,004 divided by 98,008. So, diluted EPS has to be 267.267 diluted EPS. So, the calculations are very simple and straightforward, very basic, just a matter of retrieving your memories you gathered from your normal classes. And let us go to the last question, section 5. A simple consolidation question. Let us go through the question. Financial statements for 3 entities for the year ended 30th June 18 are as follows. Statements of financial position: property, plant and equipment, investments, inventories, receivables, cash and cash equivalent, equity and liabilities, equity, capital, retained earnings, other components of equity and liabilities. On 1st July 17, BPLC purchased 45,000 shares in HPLC for rupees 100,000. At that date, HPLC had retained earnings of 30,000 and no other components of equity. HPLC net assets had a fair value of 120,000 and the fair value of non-controlling interest was 55. It is group policy to value the non-controlling interest at acquisition at fair value. The excess of the fair value of HPLC's net assets over their carrying value at the acquisition date relates to property, plant and equipment. This is the remaining estimated useful life of 5 years at the acquisition date. Goodwill has been subject to an impairment review and it was determined to be impaired by 7,000. On 1st July 17, BPLC purchased 10,500 equity shares in SPLC for rupees 21,000. At this date, SPLC had retained earnings of 25,000 rupees and no other components of equity. During the year, BPLC sold goods to HPLC for rupees 10,000 at a margin of 50%. By the reporting date, HPLC had only sold 80% of these goods. Included in the receivables of BPLC and the liabilities of HPLC are intra-group balances of 5,000 rupees. On 5th July 18, BPLC received notification that an employee was claiming damages against them as a result of work in place accident that took place on 30th April 18. Lawyers have advised that there is a 60% chance that BPLC will lose the case and will be required to pay damages 30,000. Required, prepare the consolidated statement of financial position as at 30th June 18. Let's write up the balance sheet format to get started off and then we'll do the required calculations. Non-current assets, property, plant and equipment, goodwill, current assets, inventories, receivables, cash and cash equivalent, total assets, equity capital, consolidated retained earnings, consolidated other equity components, non-controlling interest, liabilities. So, we will open up the required accounts, cost of control for goodwill calculation, non-controlling interest, consolidated retained earnings, subsidiary companies retained earnings, and let us see what else is required as we progress. Parent company seems to be company B and they have a profit balance of 200,000 on the reporting date. HPLC has a profit balance of 50,000 on the reporting date, 50,000. Other components of equity, let me take it later depending on the requirement. And just remember the reporting date is 30th June 18, that is important, 30th June 18, 30th June 18. On 1st July 17, that is 1 year ahead of the reporting date, BPLC purchased 45,000 shares in HPLC for rupees 100,000. So, let me bring 100,000 to cost of control. And it has to be say 1 rupee shares in all the companies. So, HPLC has 75,000 shares out of 75. B acquired 45, so the percentage is 60%. So, HPLC becomes a subsidiary company within the group, 100,000 investment. Retained earnings were 30,000. So, subsidiary companies profits of 30 on the acquisition date are transferred to cost of control, 30,000 retained earnings. Now, other components of equity, HPLC's net assets at a fair value of 120,000 and the fair value of non-controlling interest. So, let me work out fair value reserve. If you take the fair value of net assets on the acquisition date 120, this is the figure given, and then if you take the book value of net assets on the acquisition date, just a simple calculation, share capital is 75 and the retained earnings were 30. So, the book value would have been 105 whereas the fair value is 120. So, the fair values were higher by 15,000 than the book value, and this is considered to be attributable to property, plant and equipment 15. Let me bring it here to cost of control fair value reserve. Fair value reserve is 15,000, share capital should be 75 and non-controlling shareholders fair value is given, it is 55,000. NCI at fair value should be 55,000. So, we can close it up and take the goodwill, 155, 155,000 minus 30,000 minus 75,000 minus 15,000. So, the goodwill is 35,000 on the acquisition date. Let me bring it to the balance sheet straight 35, and there was an impairment. Let us take it bit late. And the fair value exercise carried out need to be reconsidered to calculate additional depreciation. This had a remaining estimated useful life of 5 years. So, let us recognize additional depreciation. Fair value reserve is 15,000, 5 years remaining lifetime, and let us recognize 1 year's depreciation. Why? From the acquisition date to the reporting date is 1 year. So, recognize additional depreciation of 3,000, deduct it from property, plant and equipment and debit it to subsidiary company's retained earnings depreciation on fair valuation. Depreciation on fair valuation. Next one, goodwill has been subject to an impairment review, and let us recognize impairment loss of the goodwill by 7,000, also debit it to retained earnings of the subsidiary company. Goodwill impairment, it was the full goodwill. So, the full goodwill need to get deducted from both parent and NCI. If you debit it to retained earnings of the subsidiary company effortlessly, at the end it will get deducted from the profit of both parties. So, it is easy and simple at the exam to minimize the possible human errors. Then on 1st July 17, BPLC purchased 10,500 equity shares of company S. So, let us calculate the percentage there. Equity capital 35,000 out of 35,000, investor acquired 10,005. So, the percentage is 30%. So, should be an associate company. Let me open up another account for investment in associate. Investment in associate. What is the investment made? 21,000, bring the investment as the balance 21,000, and what does it say the retained earnings were on the acquisition date? 25, no other components of equity. What are the retained earnings now? 40,000, will recognize subsequent equity changes. 40,000 minus 25, 15 into 30% is 4,005, debit to investment in associate and credit to consolidated retained earnings. Share of associate profit 4,005, and during the year BPLC sold goods to HPLC, B sells to H. So, the parent company sells, subsidiary company buys for rupees 10,000 at a margin of 50%. Then the unrealized profit should be 5,000, it is the margin, not the markup. 10,000 sales value, 50% margin, unrealized profit should be 5,000. HPLC had only sold 80% of the goods. So, then we need to recognize 20% as an unrealized profit, 20% should be 1,000, debit it to the selling company's profit. Selling company was the parent, debit it to consolidated retained earnings and credit it to inventories by 1,000. Intra-group receivables and payables are 5,000, will deduct 5,000 from receivables, also will deduct 5,000 from liabilities. On 5th July 18, BPLC received notifications that an employee was claiming damages against them as a result of workplace accident that took place on 30th April 18. Lawyers have advised that there is a 60% chance that BPLC will lose the case and will be required to pay damages of 30,000. So, BPLC is which company? BPLC has to be the parent company. So, now it is an event occurring after the reporting period, but the accident has taken place before the reporting date. So, we should recognize the probable compensation damages of 30,000, debit to consolidated retained earnings and credit to payable of compensation. Let me add it to liabilities of 30,000. So, we can complete now. We will close up subsidiary companies retained earnings, credit total 50,000, bring it to debit side, balancing figure should be 10,000, and let us take 60% to the parent and 40% to NCI. 6,000 goes to consolidated retained earnings, subsidiary companies retained earnings, 4,000 should go to NCI, credit 4,000 to non-controlling interest. Subsidiary company retained earnings, NCI figure should be 59,000, non-controlling interest 59,000. I made a mistake, you need to take one more item, other components of equity. Subsidiary company has other equity components of 5,000 that has not been there on the acquisition date. So, 5,000 need to be divided between parent plus NCI, 40% should go to NCI 2,000, other equity components, and 60% should be given to parent company 3,000. Let me bring it to the balance sheet straight. Now, we can close it up. Here 0, 61,000, NCI should be 61, and investment in associate should be 25,500. Investment in associates, investments in associates 25,500. Consolidated retained earning 0, 0, this is 50, 210,005. Minus 31,000, 179,005, 179,500. Other equity components, parent company 10,000, consolidated figure should be 13,500. Let us take the remaining figures and finish it off. Property, plant and equipment 180 plus 15 minus 3,000, 192,000. Goodwill should be 35 minus 7,000, 28,000. Total non-current assets 192 plus 28 plus 25.5, 245,500. Inventories 22 plus 30,000. 22 plus 30 should be 52,000 minus 1,000, 51,000. Trade receivable 70 plus 10 should be 80 minus 5 should be 75,000. Cash and cash equivalent 47,000 plus 25,000, total 72,000. Total should be 72. 47 plus 25, 72 plus 75 plus 51 198,000. Share capital 100,000. Liabilities 50,000 plus 15, 65,000. Total liability 65 plus 30 minus 5, 91,000. The total liabilities total 65 plus 30 minus 5,090, and the balance sheet total should be 443,500. So that is the end of the discussions of the paper. We will meet up again soon with another webinar. Thank you for watching.